1+ year, it is called long-term liabilities. Suppose if I am taking loan from the bank for 2 years, 5 years, or any kind of security I have issued, borrowed securities, I have borrowed funds from the public, and I'm going to pay off in multiple years, is called non-current liabilities. Again, it is divided based on the time. Now, what is equity? Equity is owner's contribution. So as an owner, how much you have invested in the business, that is called equity. So there are three components. One side you have an asset, and the other side you have a liability plus equity. It is look like this. So when you look at the balance sheet, you will find out the balance sheet, the one side we have an asset which is divided into two parts, current and non-current or long-term. And similarly, liabilities, long-term and current liabilities. And what is the net worth of the company in terms of shareholders. So these are the different components of the balance sheet, which you can see here. What company own is called asset, what company owe is called liability, and what is the net worth of the company is called equity. Now, Sahin is asking capital and equity same? Yes. Capital, which is coming from the owners, is called equity. Capital may also come from the borrow. If you borrow money to start a business, that is also called capital. That is called borrowed capital, or this is called debt capital. Okay. But if the capital is coming from the owner, it is called equity. Okay. Now, Muskan is asking what is treasury stock? So these are the shares which is buyback by the shares of the company. So those are the lot of the shares which is repurchased by the company. Okay. It is also considered as share warrants or the treasury stock, which is repurchased by the company. And there are some stock which is issued to the certain members, that is called preferred stock. So there are different categories in the stock that we will discuss in the upcoming session when the stock chapter will come into the picture. Okay. So preferred stock is selected to the issued to the selected members. Okay. That is why it is called preferred or preference stock. Now, additional paid in capital means additional capital paid by the owners. Any additional amount has been introduced or given by the owners to the company. Okay. Now somebody is asking marketable securities. So those securities which are marketable, which are easily sellable to the market, like suppose the the company has a surplus money and they have purchased government bonds or government securities. So these securities are tradable. They can sell it anytime. So that is called marketable security. Now, that is why I have shared a glossary book. How many of you gone through that terminology book I have shared earlier in my first lecture? Because I can see the people are asking all those terminologies which I have already shared in the first lecture. Because this is not a time to discuss all the terms, because if I start discussing all the terms and explain the meaning, it will go more than 2 hours. Okay. So that is why I have shared the glossary PDF with you, that you just go through the terminology and understand what is the meaning of term. Okay. So I have already shared the link, and you can circulate among themselves these link. If you have that link, you can circulate among themselves and go through the accounting terminologies. Accounting terms are very important to understand. Okay. I'll share again at the end of the session. So I would request you everyone, please go through that accounting term, because most of the time students are not able to understand the terminologies. If you do not understand the meaning of term, then the next step will also not be clear. So first of all, you must be clear about the term. Now, Sagnik is asking cash in hand, cash in bank in non-current liability or current liabilities. Cash in hand or cash at bank is not a liability anymore. Okay. So first of all, the cash which you have is called asset, not liability. And the cash is always considered as current assets, not fixed assets. Okay. How to solve case study. So how to solve case study, please go through the case and what is exactly is asking in the case. Refer to the textbook. You have already have a textbook. We refer to that particular chapter and go through the similar kind of illustration provided in the textbook. And from there you get the reference. Okay. Now, Nidhi is asking what is intangible assets. So, non-physical assets is called intangible assets like copyright, trademarks, license, okay, goodwill. These are called intangible assets because these are non-physical. Clear? As it is mentioned, goodwill is here. Goodwill is intangible assets. So, patent, yes, patent is also a intangible assets. Okay. Now, here we have
अरे
one
मिठाई
small
दावत है
illustrations to understand. That is the Hercules company's trial balance is provided here. Okay. So this is the trial balance of a company which is provided here. And all this trial balance information is given like cash, all the informations, debit credit form. The trial balance we have already discussed how it is prepared. So this is the trial balance is provided in the question. Now, based on this trial balance, we have to prepare the final account. Final account means income statement and balance sheet. Okay. So let's prepare the income statement first. So income statement has a two things, as I already discussed, revenue and expenses. There's only two
हाँ
things which you have to focus in income statement. That is how much the revenue we have and what are the different expenses.
9 से 17
So in as per the trial balance, I have a two type of revenue, service revenue and rent revenue. So it might be have a business two type of service and rent. So there are two revenues over here, 42,400 for the service revenue and rent revenue is 6,100. So the total revenue of the business is 48,500. Now we have recorded how much revenue we have. Now it's time to record all the expenses of the business. So you can see here, this is the trial balance we already have as a question. Now from this trial balance, you have to identify what are the expenses is provided here. So cash is an expense. Hello, please answer quickly. Is cash is an expense? No. Great. Account receivable is an expense? No. Equipment is also not an expense. Accumulated depreciation. What about accumulated depreciation? Yes, depreciation is an expense. Okay. So how much? 5,400. We just record this as an expense. Okay. Next, accounts payable is an expense. Some are saying yes, some are saying no. Account payable is not an expense, it is a liability. Okay. So it will not be recorded in income statement. Okay. Once is asking why equipment is not expense. Equipment is a asset, my dear. Okay. So whatever the plant, machinery, equipment you have in a business, that is called assets for the business. Okay. Unearned rent revenue, that is also a kind of a liability because it is not earned yet. The rent revenue is there, but that revenue which is not yet earned, it is called unearned. And the same kind of entry we have already discussed in my first lecture where I have unearned service revenue. So that I told you in that first lecture, it will be considered as liability. Now, owner's capital is a capital, it is not an expense. Drawing. What about service revenue? Revenue is revenue, we have already recorded. Now we have a depreciation expense. We have a salary and wages expense, utility expense. So these are all expenses we have. So let's go to the question and see. Salary and wages expenses, 37,100. utility expense is 10,000, and the depreciation expense is 2,700. Okay. Owner's drawing will be deducted from the capital. It is not going to be recorded in the income statement because it is already deducted from the capital. Some amount you have invested, later on you withdraw. Okay. What is depreciation expenses? So that is the question coming from Santosh. So the depreciation means wear and tear on the property which we are using. So suppose if we are using a car, and every year there are a lot of wear and tear happen with the car, so that value of the car is going to be decreased. So how much car value decreases in a year, that is considered as depreciation. Okay. Unearned rent revenue is not going to be considered as accrued because you have received advance, but you have not delivered services. Okay, Mohit, and those who having the similar question, when we deliver services and not received money, it is called accrued expense, accrued revenue. But here it is opposite. We have not delivered anything, but we have received advance from the customer, so it is called unearned. Okay, that is the difference. There's a one category where we deliver the services and later on received money, so that is called accrued revenue. But its opposite is like the customer has given me the advance and we have not delivered the services, so in that case it is called unearned revenue. Okay. Why the accumulated depreciation is not here? Because accumulated depreciation is a combination of previous depreciation as well. The further depreciation which is accumulated year on year basis, that is given there. But this depreciation belongs to this year only. So income statement only record those items which belongs to this year, current year. They are not recording anything from the future, anything from the past. Only for the current year information has to be recorded. And that is why we are checking current year performance. Okay. So we have expenses, we have an income. Total expenses is 49,900. So my expenses are more, my income is less. So what will happen? Net loss I have business in a business, that is income statement is not a ledger. Income statement is a statement which is giving you the information about the income and expense or the losses and profit of the business. Okay. Now let's go to the next statement, which is called owner's equity statement. So how much the equity has been changed during the year? As you can see, my owner's equity is given, owner's capital is given on the beginning of the year 31,700. Let's see in the trial balance how much owner's equity is given here. Can you see where it is owner's equity is given? Owner's capital 31,700. It is given in the question itself. Now, the next entry is somebody was asking where we record the drawing. So now we will record the drawing. That drawing means owners withdraw capital. How much? 12,000. For his personal use. If the profit you are enjoying, then also you have to bear the loss. So that is why the loss has been deducted from the capital. If it is profit, it will be added. If it is a loss, it will be deducted. And you also withdraw 12,000 already as a drawing. So what was the capital? How much loss we have? How much we withdraw? 13,400. So the total capital left over in the business is 18,300. How much the capital is there in the business remain? 18,300. 12,000 you have withdraw for your personal use, 1,400 you have a loss. So your capital reduced by 13,400 and left only 18,300. This clear? So there you can see in the balance sheet, you will find out the capital information. That is, you can see here, owner's capital is recorded 18,300. That is the current status of the capital in the business. Clear? Now we will record all the assets. So while going through the trial balance, we have already identified what are the different assets we have. So we have a cash, we have account receivables, we have a property, plant and equipment. And from there, I will deduct all the accumulated depreciation in the equipment. So I will deduct all the accumulated collected depreciation, that is 5,400. So this is the total depreciation incurred on the property, 5,400. That is I have deducted, and the remaining asset is left over is 5,200. Okay. Okay, Vishal Jain is asking why we deduct owner's drawing from the capital. Okay, Vishal, what is owner's drawing? Do you know what is owner's drawing? Owner's drawing means you as the owner invested money in the business and later on you withdraw some money for your personal use. So that money which you have withdraw, it will be deducted from the capital because you are the owner. What you have added into the business, now you have withdraw. Okay. So that owner's drawing is withdrawn from the capital only. Equipment is not a liability. Sorry, this depreciation is not a liability over here. It is deducted from the equipment to get the real value of the equipment. Okay. So what was the equipment value provided in the trial balance based on the previous year? 10,600. Current year, we have accumulated all the depreciation and deducted from here. So the remaining value of the asset is now 52. Last year, the last year car value was 1 lakh rupees. The entire year I have utilized the car. So it will remain 1 lakh rupees or the value of the car will decrease. Hello? If I have a car and I have utilized throughout the year, so it will reduce the value of the car. So last year the car value was 10,600. I have utilized during the year how much? 5,400. It is based on the calculation of the depreciation formula. I have calculated my depreciation, so my remaining car value is 5,400, 5,200. Next year, how much I utilize, I will deduct it, and remaining will be my car value or the equipment value. Okay. So that has happened with the equipments on all the assets, all the tangible assets is going to be reduced based on the time and wear and tear. So if you have a plant, machinery, equipment, car, vehicle, motorbikes, anything which is usable in the business, the wear and tear is common. Okay. So that depreciation has to be calculated based on the formula. Okay. We will discuss the methods of depreciation. There are two methods which are very prominent. That is called straight line methods and written down value method. So based on the certain methods, we calculate the value of depreciation, and that value has been deducted every year from the assets. Yes, only land is not going to have a depreciation. Otherwise, all the property have a depreciation. Okay. Even the building which you have constructed on land is also have a depreciation, but land doesn't have a depreciation. Okay. So that you can see here, I have recorded all the assets and I have recorded all the liabilities like payable, unearned revenues, and owner's equities like capital. And the total is 22,300 and 22,300. Now you have to ensure that your balance sheet must be balanced. You can see here the balance sheet is balanced, 22,300 here, 22,300 here. House, building, everything is same. Everything is same, my dear. Okay, so it's not about only house. Any constructed item has a depreciation. Okay, clear? Accumulated means what? Suraj, tell me the meaning of accumulated. Because depreciation you already know, but you are confused because of this term. So what is the term means accumulated? Consolidated or collected, we can say. Collected is the correct word. So collected depreciation on all the properties. So in business, you only have a one plant or one asset, or you might have a different kind of properties. So you have a different assets, like a different kind of machines, different tools, properties, equipment. When we collect everything together, it is called accumulated depreciation on all the properties during the year. Okay. How we calculate? So how many assets you have, every asset will be calculated. If you have a similar kind of machine, has a similar usage, so we will calculate sample, but every machine has a different kind of a usage, so we will calculate separately. Okay. So suppose you have a one machine which is manufacturing something, and you also have a motorcycle. So the rate of depreciation might be differ. So different assets may have a different kind of rate of depreciation. Okay. Now come to the next chapter, that is called ratios. So I'm sure in your school days you have learned the chapter is called ratio proportion. Is there anyone who have not gone through the ratio proportion chapter in the school days? Is there anyone? So ratio proportion is the basic arithmetic chapter which we have already gone through in our school days, 6, 7, 8th standard in a simple mathematics. The same chapter we are going to repeat here in financial ratios. Okay. So the calculation and the method of calculation will remain the same that you have already learned. Why I'm saying this? That so that you can correlate with this ratio calculation, financial ratio, with your previous learning. So it will be easy for you to connect and easy to calculate. Okay. So ratio is the ratio which we have already learned, but when we club with the finance, so it is known as financial ratio. So what exactly we are doing in financial ratio? We are checking the relationship between two and more than two variables. So how these two items are interconnected, how they are related to each other, that we are going to identify through the ratio. And this will help you to identify the real performance of the company. What is the real position, real performance, real situation of the company? You can identify through the ratios. So it is a quantitative method where we use some formulas and calculations to analyze the performance of the company in terms of liability, in terms of operations efficiency, in terms of profitabilities, and a different parameters we are going to judge the performance of the company. Just like we are judging any individual on a different parameters, like how is academic performance, how it is behavior, how is good in sports, health wise, um, brain wise, how it is your IQ level. Okay, so there are different parameters to analyze the individual or human being. Similarly, there are different parameters to analyze the companies. Okay, so in each parameters, we will identify the performance of the company, and based on that, we can say what is the current position of the company in terms of performance, in terms of their strength and weakness. Okay, so when we go to the ratios, there are six categories of the ratio you can find. That is called liquidity ratio, solvency ratio, profitability ratio, efficiency ratio, coverage ratio, and market prospect ratio. So ratios are very much popular in real world. Whenever we want to judge or to analyze the company performance, ratio analysis is the most important factor which is everybody is going to use. Okay, so we cannot ignore this ratio analysis for the performance analysis parameter. It is very important tool and techniques which we utilize day to day life. Now, when it is very important, so there are so many parameters. or ability to have a cash. Okay, so somebody is saying like if I say you have 100 crore rupees property, you have a bungalow, and that bungalow has 100 crore value, but in your bank account the amount is zero. So what is your liquidity? Your liquidity is zero. But if I say overall you have a property of 100 crore, so what is your net worth? What is your net worth? Your net worth is 100 crore. But do you have a liquidity? No. You have a zero liquidity because in your bank account or in your pocket, you don't have any single amount. What you have? Only a property of 100 crore. But that property is not going to helpful until unless you are not going to sell it. Okay. So the liquidity means we are checking the company's ability to pay off short-term debt. If you have a zero amount in your pocket, how you will pay the salary of your staff? How you will pay the electricity bill? How you will pay the taxes to the government, local body expenses? How you will pay? You don't have any capital, you don't have any money. So that we will see that a company which has a huge property or huge assets, that doesn't mean that company is good. We have to also check how much the company has a liquid money. That we will check through the liquidity ratio. Clear? Okay. Now I'm explaining liquidity ratio. Somebody is asking me the turnover ratio. So hold your questions. This turnover ratio will come already in the discussion, but you have to wait. Okay. Just listen what I'm saying right now. Don't ask forward questions. Okay. We will discuss everything. Okay. Now the second ratio is called solvency. So I hope you heard this term solvency. Solvency, insolvency, difference, opposite. What is solvency? Opposite is called insolvency. Okay. So what is solvency means? It's not ability to pay. Solvency means what is your capacity or what is your current positions in terms of your earning, in terms of property. So solvency is compare the company's debt level with its assets, equity, and earning. So if you are going to borrow money from the banks, so what the banks will see, okay, suppose let's see one example which is very simple. If you are going to borrow 1 lakh rupees from the bank, what is the bank is going to check from your end? What is the bank is going to check? Before checking, they will not give you single rupees. But what is they are going to check? CIBIL score, it is a parameter. But actually what they are looking, CIBIL is just a standard to measure your overall what is called overall status. But what they are going to check, they are going to check your assets and the property, and they are also going to check whether you are earning or not. So suppose if you are earning well, you have a property, you have a wealth, so they will say that your position is solvent. You are very much solvent and you are very much efficient to pay off the bill, pay off the loan. But you don't have a property, you don't have an income, then you will get the loan. If you do not have a property, you don't have assets, and you don't have a earning capacity, so the bank will never give you the loan. How you will pay off? You don't have assets, you don't have income. Anything, at least one must you have. At least you have an income, or at least you have assets, or both. But if both are missing, you don't have any assets, you don't have earning, then on what grounds the company is going to pay? Sorry, company is going to give you loan. They can't give you. Suppose if you are a working professional, you are a salaried person, and your salary is 2 lakh rupees per month. And if you go to the bank and ask for the car loan, they will definitely give you. You don't have any property, you don't have any assets, but you have an earning of 2 lakh rupees per month. they will give you the car loan. Or you have a property, you have a bungalow, you have a assets, land, building, and you have a shops, different kind of real estate you have. So based on that, your assets, they will mortgage your assets and they will give you the loan. But if both is missing, you will never get the loan. Okay, because they are going to check your solvency. So in the company side, with this ratio, we are going to check the company's overall strength in terms of equity, in terms of earning and assets. Okay. Education loan is the government scheme. Okay. It is a kind of a government schemes that they promote the education, higher education. That is why they are going to pay you. But in education loan, it's still they are looking for a mortgage. When you go to the bank, they are not giving you just blind faith. They will check what is the position you have. Okay. Yes, collateral is also the same. Okay. Now the next ratio is profitability. In this ratio, we are going to check what are the different profits you are going to earn, what is the rate of profit you are making in the business. Liquidity and solvency is not same. Liquidity means the cash amount, how much cash and the cash equivalent you have. As I said in the example, you have 100 crore rupees property, but you have a zero cash. So you will be considered as wealthy, but you are not considered as a liquid amount. Okay. And the efficiency ratio is going to check the efficiency of a company using its assets. How efficiently companies are using their assets and the property in order to generate revenue. That is going to be analyzed through the efficiency. Through the coverage ratio, they are going to check the interest payment. How efficiently you are going to pay the interest and other obligations, that is loan, to the associated parties. And the market prospect ratio, that we will check that how the company is taking care of their investors in terms of dividend payment, earning per shares, and dividend payout ratio, how they are paying dividends and other things, that we will check under the market prospect ratio. Okay, let's have one small illustrations to understand. So this is the information we have, that is we have extracted from the income statement and balance sheet. So whenever the ratio analysis comes in the picture, whenever you have a such numerical, the basic information you will be provided. Okay. From what is the source of calculating the ratio analysis? What is the source information? Anyone? What is the source of information to calculate ratio? The source is balance sheet and income statement. That is already prepared by the company. At the year end, the company already prepared and published that what is the income statement, what is the balance sheet, cash flow, and different information they have already provided. From that information, we are going to calculate the ratio. So that you can see that is the information we have already have, balance sheet information, P&L account information. And we are going to calculate debt ratio, return on sale, return on equity, current ratio, asset turnover, PE ratio. So there are 6 ratio. I am going to tell you how it is calculated. And those who are looking for that, I have to remember the formula and I have to mug up the formula. So that is not required. If you understand the concept, formula you can already also create it at the same time. If you understand the concept of the ratio, you can easily create the formula. And if you do not understand the concept, so in that case, you have to remember the formula. So what is the debt ratio? What exactly we are looking in the debt ratio? Anyone? In the debt ratio, what we are exactly looking? We are looking that how much loan or how much liability we have against the asset. Okay, I have assets, and against that asset, how much loan or liabilities I have. So the formula is very simple: liability against asset, total liability divided by total assets, multiply by 100. So whenever you need answer in percentage, multiply by 100. That you have already done your school days ratio proportion calculation. So total liability is given in this question. that is total liability, and the total asset is also given, and you have answer is 22.9%. So your liability in the business is 22.9% of the total assets. This ratio are different from the ratio analysis. Aman, why you are saying this? This ratio are different from the ratio analysis? Because in this ratio, you are using lot of financial terms. That is why you are saying. But the mathematical calculation is the same what you have learned in the ratio. Okay. Only the terminology you can see here that is new. But the method of calculation, mathematics is same. Okay. So when I'm saying this ratio and your ratio which you have learned is mathematically connected, not by terminology. Okay. Clear? Now, return on sale. What do you understand by this term return? Return means how much return you are getting back as a profit. Okay, as a profit on sale or return on sale. So when I say return on sale, I'm saying profit on sale. How much percentage I'm making profit on the sales? So when I'm comparing profit versus sales, so my formula would be income divided by sales. Net income is called net profit. So sometime it is called net income. Somebody is saying net profit, both are same. So net income divided by sales, that is 27.6%. That means every 100 rupees sales, I am making 27 rupees as a profit. Okay. Sales return, return on sales, same. Both are same. Sweta. Okay. Return on sale and sales return is same. Okay. Currency does not matter here. Whichever currency you can use, there's no change. If I change is dollar to INR, will it change anything here? Okay. Uh, Susanta, what you are saying is not same, sir. Can you elaborate what you are saying? Why multiply by 100? I'm multiplying by 100 to get the answer in percentage form. If it is the percentage form, it is easy to interpret. Interpretation become easy when the values are in percentage. Okay. Return on equity. How much return, how much profit you are making on equity investment. So again, the formula is in net income divided by equity. So that is 15%. So your return on equity is 15, means on your investment in the business, whatever the equity you have invested, you are making 15% return. Okay. Okay. A sales return, you are going to be associated with the income statement entry, journal entry. Okay. That is not my uh, means to say that the sales return is something which is there in the journal entry. Okay, that is not I am talking about. I am talking about return means here the profit is not exactly the return means something is coming back. Okay. Okay, I got where from where you are coming. So my return means here the profit. It is not about return that exactly the amount is coming back. Okay. Okay, you confused with the term which we have used in journal entry. I got it. Okay. Now, current ratio. Current ratio is a comparison between current assets and the current liabilities. So, how you are going to compare what is your current liabilities and what is your current assets? So, current liability means what? Your short-term obligation. Am I right? Within a year, how much you have to pay? From where you will pay this current liability? Anyone? From where you will pay the current liabilities? You will pay the current liabilities from the current assets. whatever your legal obligation within the year you have to pay, that is coming from the current assets. So that is the simple comparison against the current liability, how much current assets you have. And that is 3.8 times. That means if your current liability is 50 rupees, if you have a current asset 100 rupees, can you manage easily? Hello. If your current liability is 50 and your current asset is 100, you can easily manage because you have a double. Okay. So that is why it is going to check the current ratio. That means how much current assets you have against your current liabilities. If it is more than twice, more than double, it is good for the business. Okay, that is the standard norms, that if your current asset is double from your current liability, it is good. But here you can see it is more than double. Okay, now this lecture time is going to be over. So before this lecture is over, let me share the glossary, which I have told you in the beginning, that I will share the glossary link. Just give me a second. Okay, here is the link of an ebook of terminology, because I have seen that there's so many students are not understanding the term. So already share in the chat. Okay, those who are looking for the glossary link, I have already shared in the chat. Click on the link, you can able to download it. Okay, so if you are not good enough in the understanding term, please refer this terminology glossary and understand the meaning of the term. In accounting, most of the problems solved if you understand the term, and most of the problem occurred when you do not understand the term. Okay, so the understanding of the terms, or we can say the vocabulary of the accounting, must be strong. Okay, vocabulary is playing very important